So, Lynn, let's talk a bit about the weighting of commodities and gold in a well-balanced portfolio. I think a lot of our listeners are probably familiar with Redalio's all-weather portfolio, and he says 7.5 in commodities, 7.5 in gold. But like that also had the underlying assumption that you don't know what's going to happen. You don't want to have an opinion of the market. You just want to set it and forget it. So, how do you think about weighting into commodities and gold, and how do you think about it specifically in the environment that we're in right now?
So I think that's a reasonable all-weather allocation for someone who just wants like a permanent portfolio. I think in this day and age, I would split the gold allocation to say gold and Bitcoin, right? Because you have to be now gold has for the first time in a very long time some semblance of competition. Basically, Bitcoin is arguably a digital commodity with a higher stock to flow ratio than gold. Obviously, it's been on an upward trajectory as of late. And so one, they have to manage that risk. And then on the commodity side, there's a couple ways to play it. So there's another kind of permanent portfolio known as the Dragon portfolio. And what that one does, that has like a 20% allocation to commodities, but it does so through commodities trend following. And so for people that aren't familiar with trend following, it's basically like using an algorithmic systematic approach to identify markets that have an uptrend to only own them while they have that uptrend. So a very simple way of thinking of it is you can say, I want to own this asset, but only when it's above its 200-day moving average, right? And if it goes below a 200-day moving average, I want to get out of it and go to cash for that segment of my portfolio. And that's a simple method, but it's the most kind of just for illustrative purposes. And commodities tend to work better than other asset classes for trend following because, as we discussed, they're very boom bust in nature. They're very binary. So most of the time, they're not working very well at all. And then other decades, they're like the best thing out there by far. And so you basically have this thing where you're not exposed to them until they start to do well, and then you have a pretty sizable allocation. So I think how much you allocate to commodities in that sort of all-weather portfolio, I think will depend on whether or not you have any sort of trend following component. If you have trend following, you can ratchet up that allocation to a higher number. Whereas if you don't have that trend following, you want to be careful about how much you allocate to an asset class that over the very, very long run does not have great returns. And then if you specifically want that exposure because you specifically have a thesis that inflation is going to do well, there's really no upper limit other than just how diversified you want to be, how comfortable you feel with your thesis, what is your level of conviction with your thesis. There are funds out there that go 50, 60, 70% into commodity-oriented investments when they have a very kind of value and inflation and commodity-oriented theme. But I think that's that kind of concentration I think is best left to the experts or people that are poor. They're the ones with super high conviction on what's going to happen, and they'll get rewarded or punished for it thoroughly. Whereas I think the average person, I think having a slice in your portfolio makes sense. Another thing worth pointing out is that part of the reasons that equities in general do poorly in inflationary environments is because they're when we look at indices, they're generally weighted by market cap, and right before you get an inflationary environment, you've been through a long disinflationary environment, and so the companies that are on the top of the index are the ones that are most adapted to a disinflationary environment. So kind of growth-oriented equities tend to do best in these more disinflationary environments. And so it's kind of like, an extinction event's happening and the most ill-suited animals are like the ones you're over-allocated to, and the animals that are going to like survive it, like let's say, commodity producers are part of the index, they're like at like unusually low allocations because they just went through a disinflationary decade. And so basically the risk of not having a commodity slice in your portfolio, and let's say you're entirely invested in, say, the S&P 500 in bonds right before an inflationary period happens, is that the bonds are obviously bad with inflation, and then the equities, not only invested in equities, you're invested in specifically mostly the ones that benefit from that disinflationary period. So, for example, in March, like in mid 2020, energy stocks hit their lowest ever percentage in the S&P 500. They got down to like 2% of the S&P 500. So if you then go through an inflationary period, if that 2% starts to do very well, it's not going to hedge your other 98% equity exposure very well at all. Whereas if you had a, say, 5 to 10% allocation, and that goes up threefold, that can give you more hedging power if the rest of that equity index starts to run into turbulence. And so I think that's the way to think about it, is that you don't want to be underweight commodities at the end of a long disinflationary period going into an inflationary period. And that can either be making sure you actively approach that, or by having, a larger permanent allocation that either is just always there, or it does some sort of trend following.
So on your wonderful blog, one of the things that you said is that you discussed your turnover, mentioned it was pretty low, but you also adjust a periodical based on where opportunity exists. And one example you could point to would be something like bonds. You hear all about these bond allocations and how that should be and how they should be placed in the portfolio. And for a very, very long time, bonds haven't really been that attractive whenever you look at the yield, when you look at inflation. And still bond price have rallied because of the cycle that we're in right now. As we thought it couldn't get lower, it still did. So you could still make some very decent return in bonds depending on how you played it. So with that said, I don't know if you should talk specifically about bonds, but just about the major asset classes in general. Would you ever have asset classes you would not own at all? Say, for instance, something like bonds or something like stocks, simply because you think it's just so much out of favor? Or do you always approach this as saying, I just don't know what's going to happen. I just play the probabilities. So I should always have at least, just coming up with a number, 10% in this asset class, whatever that might be.
So I'm some in the middle. Things that I don't like at all, I generally dial them down to very, very low percentage of the portfolio. There are some cases where I could go to zero. I mean, I don't think, I think for young people, I don't think you have to own bonds, for example. If you don't need your capital for 30 plus years, I don't think you need bonds. But it will partially depend on what country you live in and what equity markets you're talking about. What are your other investments? What is your financial situation like? So right now, for example, I'm using bonds and cash as basically an expensive form of optionality, volatility reduction, rebalancing fuel, right? So I try in some cases, I want to be underweight cash and bonds, but they're kind of my hedge against like a liquidity crisis. If you have some sort of, say, March 2020 event where most correlations go to 1, everything crashes, I want to have some fuel to rebalance into that. But, the expensive part of that is I'm holding cash and bonds that are yielding, 0 to 2% while inflation's running at 7%. And so that is it's kind of like selling puts in your portfolio, like a little hedge that loses money over time and then pays off once in a while. And so that's how I approach that. And if someone doesn't want to do that rebalancing aspect, there's not a great reason to own bonds and stocks in this environment, at least especially compared to like value stocks and compared to, some of the commodity producers, in my opinion, if you're looking at the very long run, rather than say what might do well over the next 6 months. So for example, I didn't own any gold from, say, 2012 through 2017. And part of that was luck. Basically, gold had that huge run up going into 2011, 2012. I was a younger and less experienced investor back then. But I still had that kind of contrarian value oriented approach. And so I had gold that I had been holding since like the late 90s. And I decided to sell into that strength. I started to see on, commercials for like gold vending machines were popping up in some markets. People were talking about it's going to go to 5,000. I was like, I don't really know how to value this, but it's gone up a ton and everybody seems super bullish. So I'm going to go ahead and sell that and buy some more stocks. And that worked better than I could have guessed. I mean, I kind of accidentally got the top. And then over time, I kept analyzing the market. And eventually in late 2018, I got back in, right? So there are environments where I might go to, say, zero gold or at least zero kind of portfolio gold, like gold ETFs and things like that. I might not, I think it's, if you're using it as insurance, we talked about that self-custody physical aspect. There's a case for just never selling it, just like literally hold it in your basement and give it to your grandkids, whatever. But, other than that, I think that there are times where it's not super useful to own commodities unless you're kind of very specifically following a permanent portfolio where you're, even if you're bearish in something, you're kind of sticking to it algorithmically. But I don't think everybody has to have commodities at all times if they don't want to follow that sort of permanent approach.